Today we are covering a concept that honestly causes more confusion among smart money traders than almost any other concept. It is called the mitigation block. And here is why this video is so important. If you have been studying smart money concepts for any length of time, you have almost certainly encountered three terms that sound similar, look similar on a chart, and get used interchangeably by traders who do not actually understand the meaningful and critical differences between them. Order block, breaker block, mitigation block. Three different concepts, three different formation stories. So today we are going to uncover one and differentiate it from the others. Let's get into it. To understand mitigation block, first we need to understand order block and breaker block. An order block is the last opposing candle before a significant impulsive institutional move. In a bullish scenario, it is the last bearish candle before price launches aggressively higher. The candle where institutional buyers place their largest buy orders before driving price upward. In a bearish scenario, it is the last bullish candle before price drops aggressively lower. The candle where institutional sellers place their largest sell orders before driving price downward. Now let's talk about breaker block. The breaker block is the order block that failed. Here is the precise formation sequence. An order block forms at the origin of a significant move, as described above. Price pulls back to that order block, and instead of respecting it and reversing as expected, price breaks through it completely, closing candles through the entire order block zone with conviction rather than bouncing from it. That failed order block, the zone that was supposed to hold but did not, becomes a breaker block. Now we arrive at the concept this entire video is built around. A mitigation block is an order block that price has returned to and partially mitigated, meaning price has revisited the zone, caused some reaction, consumed some of the resting institutional orders sitting there, but has not fully invalidated the zone or broken through it completely. Let's make it simpler. When price forms an order block and then returns to test that zone for the first time, one of three things can happen. First, price touches the order block and immediately reverses strongly. The order block is fully respected, fully defended, and remains a clean, unmitigated zone. This is the standard order block. Second, price touches the order block, causes a partial reaction, pulls away briefly, and then returns to test the zone again. This partial first test has mitigated some of the institutional orders sitting in the zone, but not all of them. The zone has been partially mitigated. What remains of that zone after the partial test is your mitigation block. Third, price touches the order block and breaks completely through it with full conviction. The zone is fully invalidated and becomes a breaker block, as described above. The mitigation block occupies the critical middle ground between these three outcomes. It is not a clean, untouched order block. It is not a completely failed breaker block. It is a partially tested institutional zone where some orders have been consumed. The zone has been weakened relative to its original state, but residual institutional interest still remains at the untested portion of the zone, making it a tradable level with specific characteristics that differ meaningfully from a pure order block trade. Here is the critical trading implication that makes understanding the mitigation block so important. And this is the specific reason why treating a mitigation block as if it were a pure order block leads to consistently poor results. A pure order block carries maximum institutional conviction because every single order placed there at the origin of the move is still intact and waiting to be defended. When price returns to a pure order block for the first time, the institutional response is typically sharp, decisive, and well followed through because the full weight of the original institutional position is being defended simultaneously. A mitigation block carries reduced but still meaningful institutional conviction because some of those original orders have already been consumed in the previous partial test. The institutional defense at a mitigation block is real. There are still genuine orders remaining in the zone, but it is not as fresh, not as fully loaded, and not as aggressively defended as a pure order block because a portion of the institutional interest has already been satisfied. This means the mitigation block trade typically produces a reaction that is meaningful but potentially shorter in duration and smaller in magnitude than a pure order block reaction. Now let us get completely specific about the identification of mitigation block. Step 1 is identifying the original order block at the origin of a significant institutional move and marking the complete zone clearly on your chart, from the open of the order block candle to the close, with the full range, including wicks noted as the outer boundaries. Step 2 is identifying confluence. A strong fair value gap, FVG, serves as an excellent confluence, increasing the probability of a successful trade. This confluence helps us identify a new area of interest, known as the mitigation block, where price is likely to retrace before continuing in the intended direction. Step 3 is redrawing your zone to reflect only the unmitigated portion. Remove the section of the original order block that was reached during the first test and mark the remaining deeper portion as your mitigation block. This refined, smaller zone is now your active level, the area where residual institutional orders are still resting and where the most meaningful reaction is likely to occur if price returns for a second test. Here is your complete step-by-step trading framework for the mitigation block. When price returns for the second test of the confluence, approaching the mitigation block zone after the first partial test, your entry comes at the upper boundary of the mitigation block for a bullish setup or the lower boundary for a bearish setup. You are entering at the edge of the residual institutional zone, not waiting for price to reach the center because the mitigation block may not have enough remaining institutional weight to produce a reaction deep inside the zone. Your stop goes beyond the complete mitigation block zone in a bullish setup and above the highest point for a bearish setup. If price closes beyond the complete original zone, the residual institutional interest has been fully consumed and there is no remaining basis for the trade. For take profit, target the nearest internal range liquidity, the closest range of liquidity in the direction of the move, rather than the most distant external range liquidity. Start reading the institutional life cycle of every zone and block on your chart, and your smart money analysis will reach a level of precision and consistency that genuinely separates you from the overwhelming majority of traders who know these concepts by name but cannot tell them apart on a live chart when it actually matters. Subscribe and stay tuned.